there's nobody betting that inflation is going to be higher for longer and that the central banks are going to be raising interest rates. No one's betting that. There's no trade that looks like that. And so I prefer that as a trade. As I said, I think the recession trade is priced, the soft landing trade is priced, but the higher for longer trade just doesn't seem priced to me.
Welcome to What the Finance. My name's Anthony Fatsies and I'm the founder of the channel. So on today's episode, I'm happy to welcome Andy Constan. He's the CEO and CIO of Damp Spring Advisors. So Andy, thanks for joining the podcast today.
Sure, Anthony. Pleasure.
No problem. So I'm really looking forward to our conversation. So I guess from your perspective, what are you currently seeing in the markets? Is anything jumping out to you?
Sure, it's an interesting time. The what I think is interesting is that there are a variety of possible outcomes that I think are the major categories of outcomes. A recession is certainly a real possibility of a Fed that's done too much. We've seen growth weaken, we've seen inflation weaken, heading toward target. But jobs remain strong. So that raises the possibility that the economy is actually doing okay and accepting the financial tightening because inflation's coming down. And somehow we'll be able to miss out on the typical job loss that has been needed to cool inflation in the past. And that would lead to a central bank that can remove some of its restrictive policy and what most people call a soft landing. And then, of course, there's the third option, which is the Fed hasn't done enough. Inflation will reaccelerate, driven on the back of very tight labor. And we saw some evidence that the Friday number was potentially wonky, but we saw some evidence of pretty strong labor. And that's been a trend for a while. So you add those things up and you'd expect some broad positioning that's consistent with, well, we don't know which one of those things it'll be. And so, we have to have different exposures in different asset classes. And that's the interesting thing, because that's not what's happening. Overall, asset prices are, we've had quite a rally in, well, let's just step back for a second. About 2 months ago, I noticed, after being a resolute bull from the 29th of September through till 3,900 on the S&P, where I became neutral. I noticed, the big rally in assets that had kicked off, had continued after I became neutral, and decided to sell assets. And my thinking was that financial conditions in a recession tighten. And the reason why they tighten is people are losing their jobs, and so they're reducing spending. They are because somebody else's income is because someone's spending is someone else's income. Those people struggle to make ends meet as well, and that means that debt needs to be paid off. And when debt needs to be paid off, credit card debt, mortgage, all the normal debt that society gets, that people need to sell assets in order to pay off their debt, and then asset prices get put under pressure. And so typically what happens in a recession is money becomes very, very tight, and only by Federal Reserve easing of monetary policy does it become interesting at all to spend or invest. But that one thing has to follow the other. It doesn't happen before the recession. It happens after there's been a monetary tightening. financial conditions tightening. And so that's generally a bad environment to own assets. And in the event that the Fed hasn't done enough, they are going to need to tighten financial conditions. So whereas the recession creates tighter financial conditions with the Fed doing nothing, the Fed not having done enough and not having killed inflation requires them to act and engineer tighter financial conditions. But in both cases, financial conditions tighten. Now, specific assets behave very differently in those two regimes. But so those were the outcomes I thought most likely, and I thought we were priced for a soft landing. And so a soft landing actually is pretty good for assets because the Federal Reserve financial conditions don't tighten because people still have their jobs and they can make their debt payments. And the Fed can remove restrictive monetary conditions and go to neutral. And so that's good for assets. But that was the only way that we could, I could see assets rallying. And I thought that's unlikely. So that's why I went short assets on December 1st. Now, bringing it forward till today, that portfolio is up a little bit of money. And it's a portfolio of bonds, stocks, gold, commodities, tips, a full sort of risk parity-like portfolio. And it's up a little bit. And that tells me that, yes, assets have stayed at that rich level, but haven't come down much. And yet there's quite a bit of bullishness around. And what I would describe that is, so while my positions are in, the S&P 500, a lot of bullishness is manifested in meme stocks, post-bankruptcy, pre-bankruptcy stocks. We had a bounce and a rally in crypto, and the most heavily shorted stocks, and some of the main tech stocks have certainly bounced a lot. And so there has been an aggressive rally in January, but from a low of 3,800 on the S&P and 11.2 on the NASDAQ, or 11.1 on the NASDAQ. And so overall, nothing really has changed over the last 2 months.
Yeah, it's really interesting. As you said, if you're looking at over a pool of different assets, then it's quite consistent. But if you look at those high beta stocks that a lot of retail traders are interested in, then they're the ones that have gone up, even though they're still probably down 50% from the highs last year.
Got really amazing. And I do think a lot of that was seasonal tax selling related, which is something I missed a little bit. But there were some other fundamental things that I would look back and say I missed, and had the right call to be short assets through December, but didn't cover because I was looking for a higher return. And so here I am. Soft landing still seems to be the direction we're heading. And it's funny about landing an airplane, and taking this metaphor to an extreme. You have to approach the runway, whether it's going to be a hard landing or a soft landing. Well, I guess you could just avoid the ramp. You could say, forget it, I'm not landing. And that's the higher for longer case. But you don't know about your landing until you land. And so here we are approaching what appears to be a soft landing. And it's a very crowded trade. The way for me to express that view is to remain short assets, which I admit I have a small position relative to my capital. It's unlevered. It's 50% of my assets under management. And so it's not very risky. I've had a 1 or 2% drawdown from peak to trough on that position, maybe 3%. So mostly I just wasn't prepared to make a bet, because the bet I want to make is one that I have conviction on. And being short assets, you actually raise cash from the proceeds of the asset sale, and you invest that cash at 4.5%. that's fine for me right now, where I didn't have much of a view. But that said, that brings us back to this idea of that says that soft landing is the thing I want to fade. But I found out a trade that I think is a much more interesting expression right now, in that the short-term interest rate market is pricing 200 basis points of cuts in 2023 and 2024. Now that's changed a little bit in the last 48 hours, but still quite heavy cuts in the back half of the year. Oh, sorry, in 2023 and 2024. And that's a recessionary pricing. Could it be more? Could they cut more? Sure. But to cut that much, we're going to have to be in a recession. And yet equity markets are trading with no degradation really in expected EPS, which is very unusual in a recession, and an 18 multiple, which is looking through that recession with no damage. Now I use the term risk premium, but very narrow risk premium. And so those two things, one is pricing something that isn't a recession, and one that is pricing something that is a recession. And so I've crafted a trade that I call twos and spoos, in which I'm short 2-year notes and on a levered basis, and short S&P via puts. And I think that's the trade to have on right now, because it's really, to me, an arbitrage in that these two things both can't coexist.
Yeah, so if no matter what happens, you're ideally going to.
Well, I hope. I mean, that's the plan. The idea is that if there's a recession and they cut more than is priced in, so they cut 300, I'll lose some money on my short twos. Not much, but I'll lose some money on my short twos. But my S&P put spreads will pay off in multiples. And pretty much any other environment, my S&P puts are going to be worthless, but the amount of cuts priced in will be far less. They could actually be raising rates still if inflation were to reignite, but certainly they won't cut as much as is priced. And so I think the trade sets up well, and that's only because it's mispriced. It shouldn't set up well. That should be a trade that you can't make money on. But I think it's just this very unusual environment where people are placing a lot of chips on equities and a lot of chips on the Fed cutting, and they may be related because the equity investor has been conditioned to be long equities before a pivot, even though in history, actually, that's a pretty bad idea. But that may be placing a premium on equities while the pivot is already priced into the market. So it's a very unusual thing. So that's my current outlook. It's a combination of, I expect financial conditions to get tighter because I don't expect a soft landing. And I think within asset classes, the short rates and the short rates and the equity market are mispriced relative to each other.
Yeah, it's really interesting. And if I'm not mistaken, you think that the third option is more likely. So
the higher for longer option,
yeah, where he doesn't land the plane.
I still think it's a coin flip, but it's certainly not priced. And so while I think the probability is maybe a coin flip, the pricing is not. There's nobody betting that inflation is going to be higher for longer and that the central banks are going to be raising interest rates. No one's betting that. There's no trade that looks like that. So I prefer that as a trade. As I said, I think the recession trade is priced. The soft landing trade is priced, but the higher for longer trade just doesn't seem priced to me. So to me, that's a sign of a trade I want to be in. At the same time, it also makes some economic and macroeconomic sense that inflation could come back. And that is primarily due to two factors. One is the the strong labor market. And the other is the amount of money in credit that's circulating in the system, which you can look at simply by the amount of reserves plus the reverse repo program that the Fed has, which they've today in Powell's his interview with David Rubenstein, reiterated that QT needs to drain that for a couple of years, which is bad for assets. But, people shrugged that off a little bit because the Fed is not being listened to anymore, which makes sense because the data has been inconsistent with them staying tight until recently. And so QT being a couple of years from now will drain that excess liquidity, but that excess liquidity has the opportunity to either ignite into asset price purchases or ignite into spending. That could extend the growth cycle, the growth phase of the market, and extend inflation. And I think there's reasonable odds of that. Though that said, the inflation sure is coming in.
Yeah, it's interesting. So you think people aren't putting enough emphasis on that? They're focusing maybe too much on interest rates and what Powell will do with that, rather than the QT and the liquidity impact that will have on markets overall.
I think so. I think people don't understand the way the QT mechanism works, and how liquidity flows around the system.
Yeah, and I was listening to I think you did a recent podcast last week where you were mentioning about how Powell doesn't actually have control over QT. It's Janet Yellen. So I'd be interested to hear you explain that again. And I guess because it sounds very counterintuitive to myself, and I'm sure a lot of people as well.
Sure. Yeah. So when the Fed bought bonds, they bought duration out of the market from market participants. Pretty easy. Take away their bonds, they want to buy something else, so they go out the risk curve. Now, there aren't, unlike the UK, which is outright selling their bonds in an auction process, pushing bonds that to the private sector to buy. The Fed isn't doing that. They're just letting bonds that they own mature. They own a lot of bonds and a lot are maturing, so their balance sheet is falling. But that shouldn't have, absent the next step, that shouldn't have an impact on financial conditions, because no one's being asked by the Fed to absorb their bonds. They're just getting paid back. The problem is the money to pay them back needs to be funded. So the U.S. Treasury can fund payments to the Fed with tax dollars. But they also have a bunch of other things that the tax dollars have to spend. And in fact, they don't even have enough tax dollars for their normal spending. So not only do they have to issue bonds to fund their deficit, but they also have to issue bonds to pay the Fed. And so just focusing on the bonds that they have to pay the Fed, that's really like, well, the Fed gets its money from the Treasury. The Treasury sells bonds to the private sector. And that's the sale of bonds that matters for investors. And the choice of what bond to sell, whether it's a 30-year bond or a T-bill, has an impact on demand for assets. The T-bill there's lots of demands for T-bills, and a dollar for T-bill raise has very limited impact on any market, and a dollar of 30-year bonds matters. And so she basically can shift that lever to sterilize quantitative tightening or make quantitative tightening work particularly well.
Yeah, it's interesting. So it depends on the duration of the bonds that she's or bills that she's willing to sell.
Right. The risk, really, more so than the duration. Same thing, but I like to think of it as risk, because if you ask the market to take on risk, chances are they already have the amount of risk they want, and so they may reduce risk. Now they have to sell it to somebody else, so that forces the prices lower.
Yeah, it's interesting. So rather than focusing, I guess, on the total amount of QT that occurs, it would be a good thing to look at, as well as what type of fixed income.
How it's
Yeah.
financed. Yep.
Yeah, that's really interesting. And is that maybe why? Because from what I've seen, the spreads between sort of government bonds and credit is quite tight. So is that sort of another reason you think that that's occurring?
Well, I think the spreads between credit and corporate credit and treasuries, or anything and treasuries, it depends on the demand for what the drivers of corporate credit are. And the drivers of corporate credit tend to be economic strength. A corporate credit spread is not that different from an equity exposure. It's got some what we call convexity, but by and large, it's very similar to a long equity position. And equity markets have recovered, and with that, so have credit spreads. So I think that's more of what's happening than supply and demand of duration.
Okay, makes sense. So I guess the trade that you mentioned before, it sounds like it's quite market neutral. No matter what happens, ideally you're looking to make a return. So what would be the key indicators that you'll be watching, and what are the key things you want to see to maybe shift that to either be short the market or long the market?
Yeah, so at some point, the economy is going to is going to define the direction it's heading. And again, I think there's those three paths. And the data will help us determine that. And it's all form of data, from flows and positioning to macroeconomic data. And we'll have a sense of what's best. And my suspicion is that inflation will require a recession to be well and truly put to death. And a recession's an easy trade if you get ahead of it. And that is, you go long-term bonds and you go short equities. And that's what I think is the most likely outcome. But the path there is unclear to me. And so so I'm looking for clarity on that path, and I'll probably miss it. It's hard to catch that path. But right now, I think the path is to, as I said, higher for longer. And that path is very bad for bonds. And so you don't want to be early on the way to going long bonds. And for now, I don't want to take even that bet. I'd rather just take these relative value bets of assets versus cash, which loses in a soft landing, and 2 years versus S&P, which I think wins in most environments. And so I'm not willing to bet on an environment right now. I still think it's hard to tell. But I'll be looking for the various things that lead rapidly falling growth, or lead rebounding inflation. And those things are the things that might position me to say we're going higher for longer, or we're going into a recession. And so those are that's what I'd look to lead, and that's the way I'd manifest it in a position.
Yeah, interesting. And will that just mainly be the job reports? And I guess I'm sure there's other indicators that you could be watching there.
Sure. It's all manner of things. A macroeconomic specialist looks at all the data and tries to take little bits of it to add together into a picture. It's definitely not one thing.
Yeah, definitely. So Andy, thanks so much for your time. I really appreciate it. So I guess my last question is, what is one message you want people to take away from that conversation?
One message to take away: take risk when you think you have an edge, and be okay, particularly nowadays, in cash when you don't.
Yeah, I think I saw that was it compared to the 60/40 portfolio, cash has actually performed better than that this year.
Yeah.
I guess we post that. Yeah, so it's really interesting. So thanks again for your time. So if anyone wanted to find out more about your work or what you do, where would the best places for that be?
Yeah, at Damp Spring on Twitter is probably the best place, but you can also go to dampspring.com.
Perfect. I'll put that all in the description below. But yep, Andy, thanks again.
All right. Thanks, Anthony. See ya.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.